We have a very good registration for this webinar because it's a very hot topic nowadays. It is our pleasure to have Mr. Deepak Avasthi, Senior Manager Direct Taxes SW India, with us today, who will be sharing his expertise on the complex aspect of partnership firm taxation. He has over 8 years of experience in the field of direct and international taxes, primarily focusing on litigation and advisory. His knowledge and experience in this domain will surely provide us with valuable insights. We would also like to extend our heartfelt thanks to our knowledge partner SW India for partnering with us on this event. Their continued support has made today's session possible, and we truly appreciate their collaboration with us. We hope you find today's webinar informative and valuable. And without taking much more time, I would like to invite our today's speaker, Mr. Deepak Avasthi. Deepak ji, please take the charge and share your expertise with us.
Thank you, Akshat ji, for the introduction, and thank you, ISFA, for providing this opportunity to speak on this important topic, where we will be discussing about the taxation of partnership firms. What are the main issues? What are the key benefits? And what are the differences when it comes to taxation of partnership firms versus the taxation of companies? So let's start with this topic that is very important in today's scenario. Just a second. No? So when we talk about partnership firms, first we need to understand what is a partnership firm and how it is different from other taxpayers. So, to understand what is a partnership firm and how it has been defined under various acts, so it is important that first we understand the meaning of partnership firm, which is provided under Section 4 of the Partnership Act 1932. Because the Partnership Act 1932 is the pillar and it provides for all regulations, provisions about the partnership firms. So, Section 4 of the Indian Partnership Act 1932 says that it is a relationship between persons, more than two persons, I would be specific about that, who agreed to share the profits of a business carried on by all or any of them acting for all. That means a partnership firm will be an entity where there is a relation between two or more persons who are acting in the capacity of partner, and their main objective is to carry on a business, and they also want to share the profits of that business. So this is how Section 4 of the Indian Partnership Act defines the term partnership. Now, when we are talking about the taxation of partnership firms, it is very important that we understand the meaning of partnership firms as provided in the Income Tax Act. So, subsection 23 of section 2 of the Income Tax Act 1961 says that the term partnership has same meaning as it was provided in the Indian Partnership Act 1932. That means the meaning that has been provided in Partnership Act, it is deriving the meaning from that act also only, and also apart from the meaning as provided therein, it also includes the limited liability partnership as defined in the LLP Act 2008. Because LLP is a relatively new concept when it comes to comparison with the partnership, the previous version of the partnership, which is still prevalent today also. So that is the reason they have separately included the limited liability partnership also in the meaning of partnership. There is one important point that a partnership firm cannot enter into a partnership with another firm. although their partners can enter into partnership with the multiple firms, but a partnership firm cannot enter into partnership with another firm. But an LLP can enter into a partnership firm through its partners in if it is provided in the LLP agreement. So it is a precondition that it is provided in the LLP agreement that they are authorized to enter into a partnership. So this is about partnership firms, the meaning of partnership firms, and how it has been divided in the Partnership Act and also in the Income Tax Act 1961. So now we will move on to the tax rate applicable on a partnership firm. And what are the taxes that a partnership firm has to pay, how it is taxed, and how differently it is taxed when it comes to comparison with a company. Because if we look at the taxation rate of companies, the companies are taxed at the rate of 22% or 25% or at the rate of 30%. So the lower rate of 20%, 22% is applicable to the companies where they opt for a new regime of taxation. If a company has opted for new regime of taxation, they can pay taxes at the rate of 22%. And if in case they haven't opted for a new regime of taxation, they are eligible to offer their income at the rate of 25%. But there is a condition attaching to this 25%. The rate of 25% is available where the turnover of the company is less than 400 crores in financial year 2020-21. In that case, the company can avail the benefit of 25% rate. And in all other cases, if the turnover is more than 400 crores and the company hasn't opted for the new regime of taxation, they will have to pay taxes at the rate of 30%, as increased by the surcharge and education cess. Now, when it comes to partnership firms, they don't have any benefit in terms of taxation, in terms of the tax rate that on which they have to pay taxes. They have to pay tax at a flat rate of 30% on their total income. And if it is more than 12%, sorry, if it is more than 1 CR, they have to pay surcharge of 12% as well. And education cess is there irrespective of the amount of income that they have earned. So there is one interesting thing about the taxation of partnership firm. So recently through Finance Act 2024, there is a section which talks about a new regime of taxation for individual and HUF. So through the Finance Act 2024, there was an amendment where they expanded the benefit, they extended the benefit from individual HUF to AOP and BOIs as well, Association of Persons and Body of Individuals. But they did not include the partnership firms. That means the benefit of new regime of taxation was extended to the AOP and BOI only, and there is no benefit of new regime of taxation when it comes to the partnership firms. Even if we look into the new income tax bill that was presented in the month of February, they haven't talked about any kind of benefit in rate to the partnership firms. It's just 30% plus 12% surcharge and 4% education cess at which the partnership firm is required to pay taxes. And this is not it. There was a new section that was introduced, Section 115 BAB. So Section 115 BAB talked about the benefit of 15% rate of taxation, but that was limited to the domestic manufacturing companies only. There was a condition that if there is a domestic company who is engaged into manufacturing, they will be able to get the benefit of 15% rate of taxation. And it was not extended to a partnership firm, though this benefit was limited till 31st of March 2024 only. Like if there is a company who has started their operations or it was incorporated before 2024, then they will be getting the benefit of 15%. But the government did not talk about any relaxation in the tax rate which was applicable to partnership firm. So that is the reason partnership firms, including the LLP also, they have to pay tax at the rate of 30% plus surcharge and education cess. So this is something which I expect that while this new income tax bill is in discussion, they should also extend some benefits to the partnership firms also. Since there are many small taxpayers, there are many startups, or if someone is willing to start a new business, they start with partnership firms only. And if the rate of tax is flat 30%, it becomes very difficult for a company, for a partnership firm to manage their finance, because the tax rate is so high that they face additional burden. And in case if they want to go for the company, there are some compliances like ROC forms needs to be filed. There are multiple forms that a company needs to file. So this is something which the government needs to think about, and there should be some kind of relaxation to the partnership firms also. So this was about the tax rate that is applicable on a partnership firm. So apart from the tax rate, there is not much difference when it comes to the taxation of partnership firms. When it comes to the benefits that are available to a taxpayer, available to partnership firm vis-a-vis the domestic company, all the expenses that a taxpayer can incur, which is related to their business, whether it is a partnership firm or it is a company, they will get the deduction of those expenses in the similar manner as any other SSE gets. So, for example, if there are salaries and wages that have been paid to the employees, interest has been paid for the business, if they have borrowed some kind of capital, if rent has been paid, or if there is a depreciation on the assets which have been used for the business, and when it comes to legal and professional fees, or whether it is insurance premium. So these are few example of the expenses that a partnership firm is eligible to claim while preparing their computation of income. So there is no much difference when it comes to preparation of computation of income. So now this was about the expenses that a partnership firm can take as a deduction. There are few deductions also in which there is no prohibition when it comes to partnership firms. Whether you are a partnership firm or you are a company, you will get these deductions irrespective of your status. For example, Section 80G, 80GGA, GGC, 80IA, 80IB, IAC. These are the deductions which are available to a partnership firm as well as the company. And there are other deductions as well. Section 80IB, 80IBA, IC, IE, 80JJAA, 80LA. So these are all the deductions that a partnership firm can claim. But like we discussed, the tax rate is higher when it is when we compare it with the companies. But when it comes to the deduction of expenses, and when it comes to availing the deductions specified in the Chapter 6A, there is no any difference. They can claim the deduction of expenses in the same manner as the companies claim. They can claim the benefit of deductions in the same manner as a company would claim. So now we move on to the scheme of presumptive taxation. This is something which a partnership firm is able to claim. Now, but when I talk about the partnership firm and the benefit of presumptive taxation, the benefit is limited to the partnership firms only, and the benefit of presumptive taxation is not available to a limited liability partnership. So if you are a limited liability partnership firm, then you cannot take the benefit of presumptive taxation as provided under Section 44 AD or Section 44 ADA. So now, if I talk about Section 44 AD, Section 44 AD says that a partnership firm is eligible for claiming the benefit of presumptive taxation under Section 44 AD if the turnover of partnership firm is up to rupees 2 crores. In that case, you can offer your income at the rate of 8% of total receipts. So suppose if you have a turnover of rupees 1.5 cr and you are preparing of your computation of income and you want to avail the benefit of presumptive taxation, you can straight away prepare your computation and offer your income at the rate of 8% of that 1.5 cr. You don't need to prepare detailed profit and loss account and then prepare your computation. So this is the benefit that is available to the partnership firms. And if your more than 95% of your receipts are in digital mode or through banking channels, then this limit of rupees 2 crore has been extended from 2 crores to 3 crores also. And if you have received your money through digital modes, then you can offer your income at the rate of 6% of the total receipts. Now, if I talk about Section 44 ADA, the presumptive taxation benefit as available to the professional firms, legal firms, then the firm can claim this benefit if the gross receipts are less than rupees 50 lakhs, or if they haven't earned any income. I mean, if they haven't earned any receipt more than 5% in cash, then this limit of 50 lakhs will be read as 75 lakhs. So if the receipts of a partnership firm is up to rupees 50 lakh or 75 lakhs, then they can declare their income as 50% of the gross receipts or more than 50%, as the case may be. If they want to uh, offer to tax more than 50%, then they can do it. But one thing that is to be noted in this case, that this benefit is not available to a limited liability partnership firm. This benefit is limited to the partnership firms only, and this is the biggest advantage that a partnership firm enjoy, while this benefit is not available to companies. So the benefit of presumptive taxation can only be claimed by a partnership firm. It cannot be claimed by a limited liability partnership firm, and it cannot be claimed by a company either. So this is something which is a great relief for the small firms who have just started their operations, or I would say that they have in the course of developing their business, and they haven't earned too much, and so this acts as a benefit for the partnership firms. You don't have to comply to Section 44A, 44AA, and prepare your books of accounts. You don't need to get your tax audit done. Because if I talk about the tax audit, there is a limit of rupees 1 crore. So if your turnover is more than 1 crore, then you will have to get your books of accounts audited for the taxation purpose. But if you are claiming the benefit of presumptive taxation, you don't need to get your books of accounts audited unless and until your turnover is within the limit of 2 crores or 3 crores. And if it is Section 44 ADA, then the limit is 50 lakhs or 75 lakhs. So these are the benefits which are available to the partnership firms only. And there is one more benefit that partnership firms enjoy. They don't have to get their books of accounts audited under any other statute. Like if I talk about the companies, they have to get their books of accounts audited as per the provisions of Companies Act 2013. And when it comes to limited liability partnership firms, there is a requirement to get their books of account audited as per the LLP Act if they cross a certain threshold of receipts, which is not the case with partnership firms. So this is the key benefit that the partnership firms enjoy, even if they have to pay tax at the rate of 30%, but they can take the benefit of presumptive taxation though. So this is something which is a very good benefit for the partnership firms. So this was about the presumptive taxation. So we have talked about the tax rate. We have talked about the benefit available to the partnership firm. Now we will talk about the amounts which a partnership firm is paying, but they are not eligible to claim any deduction. Just a second. So Section 40B talks about those amounts which a firm has paid, but they cannot claim the benefit of those payments. So first one is the salary, bonus, commission, or remuneration. If a partnership firm has made payment of these four incomes to a non-working partner, then they cannot claim the benefit. Any payment that is made to a non-working partner cannot be claimed as a deduction. So then who is a working partner? So working partner means an individual who is actively engaged in conducting the affairs of the business or profession of the firm of which he is a partner. So the objective of this provision is that the amount is paid only to a person who is a working partner, not to a person who is not engaged in the affairs of the business or profession. You cannot make any payment to a person who is not at all engaged in your business, and that is the reason they have introduced this provision, and so that you cannot claim the benefit of any payment made to a non-working partner. So this is something that we need to take care that no payment is made to a non-working partner, otherwise you will not be able to get the benefit of deduction. So the second one is something that the salary, bonus, commission, or the remuneration. If it is paid to a partner, but it is not authorized by the partnership firm, partnership deed, then any payment made even to a working partner, it cannot be claimed as a deduction unless and until it is authorized by the partnership deed. So it has to be mentioned in the partnership deed that salary, bonus, commission, or remuneration, or any payment will be made to the partner unless and until it is authorized by the partnership deed. The firm cannot take the benefit of any deduction. The third one talks about the limit of remuneration that is allowable to a partnership firm. So a limit has been prescribed, and if you are making any payment towards remuneration more than the prescribed limit, then the excess amount will not be allowable as a deductible expense. So what are those limits? It says that on the first rupees 6 lakhs of the book profits, you can claim the benefit of either rupees 3 lakhs or 90% of the book profit if the payment has been made to a working partner. So up to rupees 6 lakhs, or in case of a loss, you can claim higher of 3 lakhs or 90% of the book profits. And if it is a case where you have book profits, then in excess of that rupees 6 lakhs, you can claim the benefit of 60% of the book profit on the balance of book profit. That means the eligible deduction will be calculated as higher of 3 lakhs or 90% of the book profit and 60% of the book profit on the balance of book profit. any amount paid in excess of this limit will be disallowed, and you will not be able to get any deduction. And there is no concept of carry forward, where in a particular year, if you are making payment within that limit, you will be allowed that deduction. This is not something how it works. Now, the fourth one and the last one. If you are making any payment towards interest on the capital, it is allowed up to 12% per annum only on the partner's capital balance. If you are making any payment in excess of 12%, say it's 13%, 14%, 50%. So the differential part, which is in excess of 12%, that cannot be claimed as a deduction. So any amount which is in excess of 12% cannot be claimed as a deduction. So this was about the amounts which are not deductible in the hands of a partnership firm. Now we will move on uh, to the taxation of partners' income. Like whatever amount that a partner receives from a firm, how is it taxed, and how they will calculate the taxes. So first one is the profit sharing. So whatever profits that a partner get from the firm, it is totally exempt under section 10(2)(a). Any amount that you are receiving as a share of profit, it is totally exempt. But there is one condition, that the partnership firm should be registered under the income tax act. With this term registration, I would mean that the firm has obtained a pen from the income tax department, and they are being assessed as a partnership firm. So any amount of profit that a partner get is totally exempt in the hands of the partner. But what is the rationale behind this exemption? Why this share of profit is exempt in the hands of the partners? So the reason is simple, that the firm has already paid taxes on the profits that they have earned, and if the partner is also required to pay tax, it will amount to double taxation. First it was taxed in the hands of the firm, then it is, if it is taxed in the hands of the partners as well, then it will be a case of double taxation. Now, the other portion, partners remuneration, and not only the partners remuneration, the interest part, any other salary or any other bonus that a partner is receiving, any amount that they are receiving, it is taxable under the head PGBP as per section 28 subsection 5 in the hands of the partner. So all this amount that the partner receive, it is an allowable expense in the hands of the firm, considering that the partner is the one who is paying taxes on the amount that they have received. Now section 188A, it says that every person who was the partner of the firm at any time during the previous year shall be jointly and severally liable along with the firm for amount of tax, penalty, etc. of the firm for that previous year. So, Section 188A says that it is not only the partnership firm that is liable for the taxes, it is the partners also that who are liable for the tax, who are liable for the interest or any penalty that a firm is required to pay. So, in case if a firm is not in existence, and there is a liability of tax or penalty or interest, then the partners will be responsible for making the payment to the department. Moving on to the next slide. Now we will talk about the specific cases where the tax is required to be paid. So first one, we'll discuss about the tax on contribution of assets to the firm. So if there is a partner, and or there is an incoming partner, be it an existing partner or an incoming partner, and they contribute any capital asset to the firm, then that contribution will be treated as a transfer for tax purpose. It will be deemed that you have transferred your capital asset to the firm, and the amount at which that capital asset is recorded in the books of the firm, that will be treated as the value of that capital asset, and it will be deemed that this is the sale consideration that you have earned. So, for the purpose of taxation, any amount that is credited in the books of firm, that will be deemed as a sale consideration, and in that year itself, you will have to pay tax under the head capital gain if you have earned any gains from such transfer, from such contribution. So if suppose there is a building that is being contributed by an incoming partner, or the existing partner, and the value is 2 crores that has been recorded in the books, and it was purchased by the partner at rupees 50 lakhs, then the differential of 1.5 cr will be considered as the capital gain in the hands of the partner. So whenever any asset is contributed to the firm doesn't pay any taxes. It is the partner who will be liable to pay capital gain tax on such transfer, any gain that they are deriving from that. Second case that we will discuss is the transfer on dissolution or reconstitution of firm. So, if suppose there is a dissolution of the firm, or there is reconstitution of firm, like one of the partner is leaving the firm, or the firm has been dissolved, and in that case, if a partner receives any capital asset or any stock in trade from the firm, then it will be deemed that that particular asset has been transferred to the partner in that particular year. And this is very interesting. It says that the profits or gains that arise in that transfer, it will be considered as the income of the firm in the year in which that partner has received those assets. So it is the partner who is receiving those assets, whether it is a stock in trade or it is a capital asset. But any gain that is arising, it will be taxable in the hands of the firm, not the partner. So the relevant section here is section 9b, which says that any gain arising on such transfer will be taxable in the hands of the partnership firm. If it is a capital asset, it will be capital gains, and if it is a stock in trade, it will be deemed as PGBP income, and accordingly it will be charged to tax in the hands of the partnership firm and not the partner. Moving on to our next example, when there arises capital gains on reconstitution of a firm. So like we discussed in section 9b, this is a bit different, considering that section 9b talks about the cases, but specific section would be section 45, which talks about the capital gain taxation. So there is a subsection 4 of section 45 which talks about the capital gain on reconstitution of the firm. It says that if the firm distributes any asset to a partner during its reconstitution, it will be considered as that the firm has sold that asset at its fair market value, and accordingly, whatever capital gain arises, the firm will be required to pay tax on such transfer, since the firm has distributed those assets. It is different from section 9b, which says that it will be taxable in the hands of the partnership firm only. So any capital gain that arises on distribution of assets, it will be taxable in the hands of the partnership firm. Next is if the asset is distributed to capital asset. Sorry, if the capital asset is distributed to partner, it is similar to reconstitution only. That if there is an outgoing partner, and they get any capital asset from the firm, it will be deemed that the firm has sold those assets to the partner, and whatever the fair market value of that capital asset is, that will be considered as the sale consideration. So if it is a case of reconstitution of a firm, or if it is a case of distribution of any capital asset to a partner, in both the cases, if the partnership firm transfer a capital asset to a partner, any gains arising from that transfer will be considered as capital gain, and the partnership firm is required to pay taxes on such capital gains. Now we will discuss about a specific case where a partnership firm is converted to a company. So what happens when a partnership firm is succeeded by a company? What will be the tax implications? Will it be a taxable transfer, or it is a tax neutral transfer? So there are a few conditions. If that those conditions are satisfied, there will not be any case of capital gain tax. It says that when a partnership firm transfer its assets to a company because of succession, that means the firm has been converted to a company. So the transfer of assets, transfer of capital asset will not be considered as a taxable event. But provided there are few conditions that needs to be satisfied. First one is that all the assets and liabilities of the firm must be transferred to the company. Not a single asset should be left being transferred to the company. Second one is that all the partners of the firm becomes shareholders of the company, and their shareholding is in the same proportion as their capital accounts in the firm. So suppose there are four partners, and their profit sharing ratio is 25%, 25%, 25%, 25%. So each partner is eligible for 25% profit in the partnership firm. And due to this succession, they become the partner of, they become the shareholder of the company. But there is a condition that their shareholdings should be in the same proportion. They should be eligible for 25% in that company also. The third condition is that the partners don't receive any other benefit apart from the shares of that company. They will not, there should not be any case that they are receiving any cash or any other benefit or any other capital asset or stock in trade from the company. It should only be the shares of the company that a partner should receive. And the last one is that the shareholding of the partners in the company must not be less than 50% of the total voting power, and it must be maintained for 5 years. So the last condition says that their combined shareholding cannot be less than 50%, and it should be maintained for 5 years. If any of these conditions are not satisfied, then this succession will be considered as a transfer, and any transfer of asset will be considered as a taxable event, and and the partnership firm will not get any benefit, and they will be chargeable to tax accordingly. So, in the next slides, we will talk about the assessment of a firm, that how the firms are assessed, and what are the typical issues when it comes to assessment of a firm. So, first one talks about change in the constitution of a firm. It says that if one or more partners are admitted, or one or more partners ceased to be partners, and at least one person who was partner of the firm before the change continues as partner, then it will be considered as a change in the constitution of firm. And second, it says that all partners continue, but there is a change in profit sharing ratio. In that case, how the assessment will be done? So section 187 says that assessment shall be made in considering that the partnership firm was same as it was constituted at the time of assessment. That means for a particular assessment year, if the assessment is going on and during the assessment there is a change, but it will be considered that the same structure of the partnership firm has been maintained as it was in the relevant assessment year. Now coming to section 188, when it talks about the succession of a firm, it says that if a partnership firm is succeeded by another firm, then the assessment will be made separately on both the firms. So suppose the partnership firm is succeeding between the year, like on 31st of October, the partnership firm is succeeded by another firm. So till the date of 31st of October, the assessment will be made on the previous firm or the firm that has been succeeded. And after 31st of October, any operations that has been conducted will be completed on the new firm that has succeeded that firm. So there will be two assessments. First will be on the predecessor firm, and the second would be on the successor firm, and they will be independent proceedings. Next one is if the firm is dissolved or the business has been discontinued. So section 189 specifically talks about the assessment where the firm has been dissolved or the business has been discontinued. It says that if the firm has been dissolved or business has been discontinued, the AO shall make assessment on the firm as if no such dissolution or discontinuation has taken place. What does it mean? It means that even if the firm is not in existence, even if the business has been discontinued, the assessment will be made in the same manner as if the dissolution or discontinuation of business hasn't taken place. That means the assessment will be conducted in the same manner, and all the partners will be responsible for any tax liability, interest, or penalty that arises. So this is about the assessment part. Now, when it comes to the normal assessment, the assessment that takes place under section 143 or reassessment under section 147. So there are a few conditions where a partnership firm can be assessed as a firm and not the assessment of individual partners. So what are those conditions that a partnership firm is assessed as a partnership firm only? So the first one is that there is a return agreement. There is a return partnership deed. Second one is that the profit sharing ratio is clearly defined in the agreement, in the partnership deed. Third one is that the partnership deed, the certified partnership deed must be submitted along with the income tax return during the course of assessment. And then the last one is that the partnership deed is signed by all the partners. So the main essence of section 184 is that a signed deed must be in place, must be maintained by the partnership firm, and it should clearly define all the pointers or all the conditions or the profit sharing ratio. Anything that is paid to the partner, it should be clearly defined in the partnership deed. But what happens if any of the conditions are not satisfied under section 184? Then there is a section 185. It says that if the partnership firm fails to comply with section 184, and or there is a reason to conduct the best judgment assessment under section 144, then the partnership firm will not be eligible to claim any deduction towards the payment made towards interest, salary, bonus, commission, or the remuneration that they have paid to the partners. So in case best judgment assessment is made, these payments will not be taxed in the hand. These payments will not be taxed as income under the head PGBP in the hands of the partners if it is not allowed in the hands of the firm. So now moving on to our next topic, alternate minimum tax, which is similar to the MAT provisions which are applicable on a company. So more or less, these provisions are same, and these are applicable on a partnership firm. So if I briefly discuss about the alternate minimum tax, the AMT. AMT is a tax levied on the adjusted total income, where the tax on normal income is lower than AMT on adjusted total income. It says that if the tax if the tax rate on the adjusted total income is so if the normal tax payable by a firm is less than the 18.5% of the adjusted total income, then the firm is required to pay AMT at the rate of 18.5%. And there is a concept of AMT credit being carry forwarded. So it can be carry forwarded for up to 15 assessment years, and it can also be set off against the regular tax liability up to 15 years. So, but there is one interesting thing that that needs to be highlighted. There is a clear difference between the MAT liability and the AMT liability applicable on the partnership firms. While MAT is payable at the rate of 15% only, but AMT is payable at the rate of 18.5%. So there was an amendment which was applicable with effect from 1st of April 2020, which says that the MAT is required to be paid at the rate of 15%. Otherwise, earlier it was 18.5% only. So here also we can see that the department is pushing the benefits to the companies only, and they're not providing any benefit to the partnership firms. Like in this case also, AMT is required to be paid at the rate of 18.5%, while the MAT is required to be paid at the rate of 15% only. And there is one more thing. If a domestic company opts for a new regime of taxation, they the provisions of MAT don't apply to that company, which is not the case with the partnership firms. Irrespective of the amount of tax that they pay, AMT provisions will still be applicable, considering that there is no any beneficial regime that is applicable to the partnership firms. So this is something that the department should also think about, that there should be parity between the partnership firms and the domestic companies, at least up to a certain extent. Now we will talk about some other issues that the partnership firms face, or I would say that there's few important points that a partnership firm should take care and they should consider while they conduct their business from a taxation point of view. First one is that the partnership firm must be registered so that it can claim the benefit of deduction for any payment made to the partners. Unless and until it is registered, they will not be able to claim the benefit of any payment made to the partners. Other one is that they must maintain proper records of the partnership deed, capital accounts, and other tax related details of whatever payments that they made. There should be a proper record. Next one is if they're not able to maintain those records, they will face challenge in claiming those deductions, and they will be disputed during the assessments, like we discussed in our previous slides. The other one is that the other issue that the firms face, that if there is a partner who is retiring, they might have to pay tax on the sale of their share in the firm. But there is one difficulty, that if that partner is receiving any asset, then it becomes very difficult to value those assets. It can be quite complex also. And there is a new provision, section 194T, which talks about the TDS on any payment made to the partners if the payment has been made in excess of rupees 20,000. So this section is applicable irrespective of the fact that the partnership firm is required to get their books of account audited or not. Even if you're not liable for audit, you will have to deduct TDS under section 194T, because it does not provide for any exception. So this is a new compliance that is something which is acting as a challenge for the small firms, because most of the time they don't have a fancy setup, or I would say that the qualified staff, they lack in that expertise. So it is something which is very challenging for the small firms. And other aspect is that if there is a partnership firm which is involved in an international transaction. So for international transaction, I mean that they are entering into a transaction with their associated enterprise. Then they have to comply with the transfer pricing provisions also, and they have to maintain the documentation and the transfer pricing filings and all. They need to do that. So these are some issues that are faced by the partnership firms, more specifically the small partnership firms. So now we will move to the latest amendments that has been made. So we have already discussed about section 194D, which is effective from 1st of April 2025, where if any payment is made which is in excess of rupees 20,000 and it is made to a partner, then there is a need to deduct TDS at the rate of 10%. Another important amendment that was made in 2021, through Finance 2021, it was made in section 45. So the earlier subsection 4 was replaced with the new subsection 4. It says that it talks about the taxation in the event a partner is outgoing or a partner is retiring from the firm. So now the tax liability is determined based on the capital account balance of the outgoing partner in the books of the firms. Any cash that they have received, or any asset they have received, the balance in the capital account will be compared with the cash paid or the fair market value of the asset that has been distributed to the partner. So how it will be done? So if it is a case where the cash plus fair market value of that capital asset is less than the capital account balance, then there will not be any tax under section 45(4) in the hands of the partnership firm. But if it is a case where the cash plus the asset plus the fair market value of the asset that they have received, it is more than the capital account balance of the partner, then the partnership firm will be required to pay tax on that particular income. And there will be no tax that will be levied in the hands of the partner. It will be the partnership firm who will be paying those taxes. Now, one of the interesting amendment that budget 2024 provided, it was increase in the allowable limit of remuneration being paid to the partners. So earlier the limit was that on the first rupees 3 lakhs, the deduction was available up to rupees 1,50,000 or 90% of book profit, whichever is more. And on the balance, it was 60% only. So now this limit of 3 lakhs and the limit of this 1,50,000, it has been increased from 3 lakhs to 6 lakhs. And this 1,50,000 has been increased to 3,50,000. So this is something which was a welcome move for the partnership firms. So now we will discuss some few important cases which are very relevant for the partnership firms. First one is Unitech Marketing Services, which was decided by Mumbai Tribunal. It says that even there is an absence of specific remuneration in the partnership deed, the partnership firm can claim the benefit of deduction of remuneration even if they have not provided that what will be the exact amount of remuneration that will be payable to the partners. So even if you haven't specified that what will be the amount of remuneration payable to the partner, and it is within the limit provided under section 40b5, then the partnership firm will be eligible to claim the deduction of that remuneration. So the next one is in the case of Great City Manufacturing Company, which was decided by High Court of Allahabad. It says that if I talk about the facts briefly, the assessee paid significant remuneration to the working partners, and the AO said that it is quite excessive when we compare with the employee salary. So the High Court of Allahabad held that you cannot import Section 48(2) in in this 40B, because Section 40B is an independent section, and 48(2) is an independent section. You cannot say that this is not reasonable, or it is an excessive to the fair market value, or the remuneration that is paid to the workers and to the employees. If it is within the limit of Section 40B, then the whole amount will be allowable as deduction. You cannot say that it is unreasonable as per Section 48(2). So High Court of Allahabad fairly mentioned that if it is within the limit of 40B, then whole remuneration will be allowed. Next one is in the case of Pramod Mittal, and this is a case which was decided by Delhi High Court. It says that the taxpayer claimed to set off a loss from previous operations of his firm with the sole proprietorship. So they were claiming the loss of previous partnership firm after the dissolution with his income as a sole proprietorship. So Delhi High Court says that the partnership firm and the individuals are separate taxable entities, and they cannot allow the set off of losses. It held that only the person who has incurred the loss can only get the set off of such loss. The next one is in the case of Anil Hardware, and this was decided by High Court of Himachal. It says that the partnership did, I mean, if it specified the manner of fixing remuneration based on book profits, then also in that case the remuneration will be allowable. I mean, in simple terms, if I say that if the deed says that the remuneration will be paid, which is in accordance with the allowance made by the Income Tax Act, then that remuneration should be allowed. You cannot say that you haven't clearly defined the manner in which the remuneration will be paid. If you have mentioned that this is the manner in which the remuneration will be paid, then it is a sufficient compliance, and you can take the benefit of so you can take the deduction of remuneration. Moving on to the last two cases. First one is with the Madras High Court in the case of Anand Kumar. It says that the assessee was a
Deepak ji,
partner in.
sorry to interrupt you. Please wrap up. We need to wrap up the session because we have a questions also.
I'll
So,
just take two more minutes.
okay, sure.
Yeah. So this is in the case of Madras High Court, in which there was an assessee who was a partner in a firm, and he filed its return of income, claiming the deduction, claiming the benefit under Section 4480, the benefit of presumptive taxation. So High Court says that the remuneration and interest received by the partner cannot be considered as business income under the relevant, cannot be considered as business income, and accordingly you cannot take the benefit of Section 4480, the presumptive taxation scheme. And the last one is the case of GT Cold Storage in the case of High Court Allahabad, which say that the Section 40B applies to any salary paid to a partner regardless of whether they represent themselves or another entity. So the facts were that the Karta of an HUF was a partner, and I mean, he was partner in the capacity of HUF only, and he was deriving remuneration from there. And the partnership firm was claiming the benefit of a deduction for the remuneration paid to the partner in the capacity of Karta, and it was in excess of Section 40B. So the High Court of Allahabad said that any amount that has been paid to you, if you are representing HUF or you are receiving in your individual capacity, it will be clubbed and will be considered for the provisions of Section 40B, and that will be governed by Section 40B only. So this is it from my side, and now I think we can take the
Yes.
questions.
So first question in our first we take the questions from the chat box. The first question is surcharge in on income or basic taxes.
Just a second. Let me also look into the surcharge in on income or basic tax. So the surcharge will be paid on the basic tax. So the suppose that there is total income of rupees 1 CR, and the basic tax is 30 lakhs. So surcharge will be calculated on this rupees 30 lakhs only. So 12% on this 30 lakhs, 3 lakh 60,000 to be specific.
Okay. And next question is if any LLP firm deals in legal services, can they avail the this benefit of presumptive taxes?
Yes, yes, they can. They can. You're on mute, Akshat.
So in Q&A we have one question,
Hmm.
and in my personal personal chat I received 4 to 5 questions. So first I
Okay.
ask question of the Q&A box. If
Hmm.
partnership firm is in loss and income tax filing is not done since many years,
Hmm.
how to close it and how the PAN card can be closed?
If partnership firm is in loss and income tax filing is not done since many years, how to close it, how the PAN card can be closed. So in that case, you need to contact with your assessing officer, mentioning that in the last few years, I mean, you will have to show the computation of income along with the financial statements, even if you haven't filed your income tax return. You need to portray that there is no tax liability on your firm, and there was a reasonable cause which prevented you from filing your tax return, and there is no tax escapement that has happened. And if you make that application to the assessing officer and you are able to justify that you haven't earned any income and you haven't escaped any taxes or any income, then the AO will be able to grant you this relief, and they can surrender your PAN registration. You're on mute. Sorry, Akshat.
Sorry. We have one more question in our chat box. Can you please let me know how much the presumptive tax would be charged in LLP who serves legal services?
Um, so the tax rate will be calculated in the manner that suppose you have earned, like me in my example, so suppose you have earned 1 CR as sorry, suppose you have received rupees 1 CR towards your receipts, then you will consider 50% as the your total income, because 44 ADA says that you will have to offer 50% as the total income. So the 50% is 50 lakhs. So 50 lakhs is the amount on which you are required to pay tax. On this 50 lakhs, you will apply the rate of 30%, which will come to rupees 15 lakhs. 15 lakhs tax, and on that 15 lakhs you will apply surcharge of 4%. So this is how you will calculate your taxes if you are a legal firm and going for the presumptive taxation scheme.
Deepak ji, I pasted 3 questions in chat box for you, which I
Just a
received on
second.
my personal, and
Just
I'll check other questions. So meantime, you just answer these, please.
sure. I'll just see. So Akshat ji, these are very specific questions which needs elaboration, and it will take sufficient time to answer these questions. I mean, first one is about the SMRC's tax treatment, um, which is something which I need to analyze. I need to analyze the impact. And the second question: what is the impact of increasing national insurance cost on partners in professional service firms? So if I talk about the impact of national insurance cost on partners, I mean, I could not understand which kind of impact they want to understand. I mean, if they can be a bit specific in their question.
Actually, we have a short of time, so I request to the participant who raised this query, he can directly reach out to the Deepak ji, and we also share his detail in our thank you mail along with the PPT. So you can directly reach out to the SW team and Deepak ji team. So they will answer you on your specific query.
They can
Deepak ji,
drop an email.
Deepak ji, two more questions we also have. I forwarded to you in chat box. Please
So
check.
these I can answer quickly. So first
Okay.
one is related to the TDS on payments to partnership firms. So if I talk about the impact of this new amendment, even if the firm is not liable for tax audit, they will have to deduct the TDS. So there is in many sections there is a requirement that if the firm is liable for tax audit, then they need to deduct the TDS and deposit that. So there are many firms who are making these kind of payments, but they haven't taken the TAN registration. But with the introduction of Section 194T, even if they're not making, if even if they're not falling within the range for TDS on other sections, they will have to obtain the 10 and deduct the TDS on section under Section 194C. So this is going to impact the small firms. And the second one is, will partnership firms benefit from a concessional tax regime? So the answer is no, like I discussed in my previous slides. There is no beneficial or concessional tax regime that the department has proposed. Even in the new tax bill, they haven't proposed any kind of new tax regime. But we are still waiting for it. If it comes, then I think firms will be able to claim the benefit. But as of now, there is no beneficial tax regime.
Thank you very much, Deepak ji, for your expertise and insights and sharing with our participants. And thank you very much to SW for their continuous support to us for giving the perspective of the law firm, law and taxation to all our industry participants. And we look forward the future association as well. And on the side of ISFA, I would like to thank to all our participants those are joining us today. And our next session will be on 18th of March, which is on roadmap for the IPO for SMEs. So please join us for that. And if you are not registered till now, please register and follow us on our all social media handles and subscribe our membership for latest update and details and connect with the people like Deepak ji, the expert of the industry, so that you can get the better solution for your problem or your queries. Thank you, Deepak ji.
Thank you, Akshat ji. Thank you,